The US jobs market accelerates, but is it a sign the economy could overheat? Welcome to Macro Matters. I'm Elena Casas. The US economy added 256,000 jobs in December, when the market was expecting just 160,000, and the unemployment rate has fallen to 4.1%. That's a very strong number when the Federal Reserve has started worrying about a comeback for inflation. Well, Lauren Saidel-Baker is an economist at ITR Economics, and she's with me now. Lauren, hi. What's behind this surprising strength, do you think?
Well, I want to stress that this is just 1 month of data. There will be revisions to the number, but overall, this is a very strong trend. Really, we still see a stable labor market, even quite a tight labor market by historical standards. Really, the problem that companies have had with hiring, it isn't creating the jobs, it's been finding individuals to fill the jobs here in the United States. So as you said, headline blowout number, this is showing that continued strength. Generally, we at ITR Economics expect demand to be picking up in 2025, so I think we will see more good news on the hiring front.
You mentioned that employers are struggling to fill gaps. There's a skills gap in some sectors, including construction and manufacturing, and particularly ones that have a strong presence of undocumented workers who the incoming president has threatened to deport. What could that mean for the labour market?
This is absolutely going to cause really hinder further labor availability, as you mentioned, especially in fields like construction. I read one estimate that said 1 in 4 construction laborers are undocumented in the United States. So if we do see mass deportations, or even if we just see policies that hinder those folks going to work, right, that disincentivize them going in, risking some kind of raid, we very likely will see the construction market cool off this year because they just can't get crews on site. If you can't get the crew on site to build, that delays one project, it rolls into the next. And I do see this as a bit of a downside risk to construction in 2025 and beyond.
Employers struggling to hire is, of course, inflationary. It means they need to offer the people more money. So does this mean the policy outlook for the Fed is now much more uncertain with a hot job market?
Absolutely. We have been seeing wage inflation really be the stickiest factor behind rising prices. That is true in recent years. I expect it to be even more true from this point forward. Now, the risk of items like tariffs, that would tend to be inflationary on the goods side. And I do want to be absolutely clear. There are many other fundamental factors, non-policy factors, that are starting to show that inflationary resurgence probably on the back half of 2025. So we at ITR have been expecting resurgent inflation this year. Any of these inflationary Trump policies would probably add on top of that level, but I'm not surprised to see the Fed start to dial back, as they did in their December meeting, some of these targets for how many cuts they'll do in 2025. Their base case is now just 50 basis points of cuts in this year. I think by the end of the year, I wouldn't even be surprised if we start to see talk of rates rising instead of declining.
This jobs number caused a jump in Treasury yields today as markets price in those fewer Fed cuts. Should we be worried, Lauren, about the rising cost of servicing America's debt as it continues to rise?
Worried, maybe not quite yet. I think we still have several years that we can continue down this path, but I am longer term very concerned. We are really watching this overspending, this deficit spending that year after year rolls into more and more debt. I think by 2030, that is when I'm really looking for these chickens to come home to roost. This will eventually be a problem that we just can't kick down the road any further. But for the immediate term, no crisis expected. Higher cost of borrowing, though, and more than anything, bigger debt burden. That will certainly plague us probably around the end of this decade.
Going back to the labour market, you mentioned in your notes that longer term, Gen Z, who are just entering the job market, will be insufficient to replace retirees. What will that mean a few years from now?
This is absolutely going to be inflationary as we look at just where can we find more workers. The easy answer is, well, let's look at that younger cohort who's just now aging into the labor force. For us in the United States, Gen Z, they're a relatively smaller generation. So as you say, they are not going to be able to replace on a one-for-one basis retiring baby boomers. That means we'll have to look elsewhere for more workers. Maybe that's immigration. The current incoming administration doesn't seem to be going down that road. So I think businesses will have to either pay more for workers, but at the end of the day, they'll have to do something to make their existing human workforce more productive. So I see AI, any amount of tech or automation, robotics really helping at the end of the day. There will be some investment required, which at this relatively higher cost of borrowing, as we talk so much about interest rates, certainly will come at a cost. But I think those costs will be very well worthwhile when you're having to pay more for these existing human workers to begin with.
Saidel-Baker of ITR Economics, thank you so much. Well, that's Macro Matters. Don't forget, you can watch more videos on Reuters.com.